In this session, we're going to take a look at the self-assessment regime, and in particular we will concentrate on the filing deadlines for self-assessment returns, penalties for late returns, and penalties for incorrect returns. But before we do that, let us take a few minutes to have a look at the structure and the organisation of HMRC. We know that the UK tax system is administered generally by central government, but the ministry concerned with the collection and imposition of taxes is the Department of the Treasury. The Treasury is also known as the Exchequer, and at the head of this department you will find the Chancellor of the Exchequer. The administration of taxes in the UK is in the hands of the Commissioners for His Majesty's Revenue and Customs. As the name suggests, the Commissioners are technically appointed by the Crown. The Commissioners in turn appoint civil servants to do the actual work of administration. These civil servants are called Officers of Revenue and Customs, often shortened to Revenue Officers. In this session and the ones that follow it, we are concerned with the administration of income tax and capital gains tax. Rather than the long-winded name of HM Revenue and Customs, we will simply refer to HMRC. A two-tier tribunal system, comprising the first-tier tribunal and the upper tribunal, deals with points of dispute between taxpayers and HMRC. Self-assessment is the regime by which HMRC assess and collect direct tax in the UK. In the UK at present, we have around 36 million people who pay tax. Out of those 36 million people, around 12 million prepare income tax returns under the self-assessment system. Taxpayers who are self-employed and earn more than £1,000 per annum must submit tax returns, as must individuals who receive more than £10,000 from dividends or savings and investments. Taxpayers who have other untaxed income, for example property income in excess of £1,000, also have to file tax returns. The most common example of untaxed income, i.e. income from which tax is not deducted at source, is property income. If you rent out a property, you have an obligation to report the property income from that rental to HMRC by means of a tax return. Finally, a taxpayer who has a taxable capital gain in the year will need to submit a self-assessment return. We can see, therefore, that there are around 24 million people in the UK who pay income tax, but who do not have to fill in an income tax return. These will primarily be employees, whose tax is deducted at source under the pay-as-you-earn system, and who only have small amounts of income from dividends or savings and investments. Before we get into the nitty-gritty of self-assessment, let us take a look at the requirements to notify chargeability to income tax or capital gains tax. The basic idea here is that if you become chargeable to income tax or capital gains tax for the first time, you need to write to HMRC and inform them that you exist. Keeping a low profile and earning income without paying any tax is a serious offence under tax law, and one that can carry a stiff penalty. If an individual becomes chargeable to income tax or capital gains tax, he has a duty to notify HMRC within 6 months of the end of the tax year in which he became chargeable. Assume an individual starts to receive property income in the tax year 2024-25. He becomes chargeable to income tax for the first time in 2024-25, so that the taxpayer has 6 months from the end of the tax year 2024-25 to give notice of chargeability. The deadline for notifying HMRC is the 5th of October 2025. In our example, we've taken the example of somebody who first receives property income in 2024-25, but the notification rules apply in the same way if the taxpayer has a capital gain or any untaxed interest or starts to trade in 2024-25. If the taxpayer misses this deadline, HMRC will charge a penalty. The penalty will be based on the behaviour of the person concerned and is a percentage of the potential lost revenue. The potential lost revenue is the amount of income tax, including Class 4 national insurance contributions if relevant, and or capital gains tax unpaid, at the 31st of January following the tax year as a result of the failure to notify. For a deliberate and concealed failure, the penalty will be a maximum of 100% of the potential lost revenue. For a deliberate but not concealed failure, the maximum penalty will be 70% of the potential lost revenue. And for any other case, for example due to lack of care, the maximum penalty will be 30% of the potential lost revenue. A failure is deliberate and concealed, where the failure is deliberate and the taxpayer makes arrangements to conceal the situation giving rise to the obligation. This would include creating false evidence of a non-taxable source of income to explain undisclosed income or destroying books and records. A failure is deliberate but not concealed, where the failure is deliberate but no arrangements are made to conceal the situation giving rise to the obligation. An example of this would be where a person is aware of the obligation to notify a source of income but decides not to do so, without taking steps to conceal the income. Reductions in the amount of the penalty are available for both unprompted and prompted disclosures. The table now appearing on your screen details the maximum and minimum penalties that could apply. For example, if a taxpayer has failed to notify and their behaviour is deliberate and concealed, they will be charged a penalty of between 30% and 100% of the potential lost revenue if they make an unprompted disclosure of the failure to HMRC. Note that where the taxpayer is simply careless in not making the necessary notification, the reduction in penalty also depends on how long has elapsed since any tax or NIC first became unpaid as a result of the failure. Disclosure is unprompted if the taxpayer has no reason to believe HMRC have discovered or are about to discover the failure. Disclosure takes place when a taxpayer tells HMRC about the failure and gives HMRC reasonable help in calculating the resulting unpaid tax, and allows HMRC access to records to check the amount of unpaid tax. The actual reduction in the penalty depends on the quality of the elements of disclosure, including timing, nature, and extent. Increased percentages may apply where the late notification relates to an offshore matter, such as income arising or assets held overseas, or an offshore transfer where income or proceeds are received offshore and are moved offshore before the tax is due for payment. The actual rates depend on whether the overseas country is a Category 1 territory, in which case the above rates apply, or a Category 2 or 3 territory, in which case increased rates apply as set out in the legislation. A new Category 0 will be introduced from a date to be appointed. The rates shown in the above table will apply when an overseas country is in Category 0, with increased rates applying to countries within Categories 1, 2 and 3. In addition, a greater level of disclosure is required in order to obtain a reduction in the penalty where the behaviour is deliberate. We can illustrate the failure to notify penalty provisions by considering the position of Oscar. Oscar started to trade on the 1st of July 2024. He was very successful and did not have time to consider his self-assessment responsibilities. As a result, he did not notify HMRC of his self-employment by the 5th of October 2025. HMRC contacted Oscar in July 2026, and as a result, Oscar appointed a tax advisor. HMRC was subsequently notified of the self-employment. The tax return for 2024-25 was filed in August 2026, showing the tax and Class 4 NIC due of £15,000. It would appear that the failure to notify HMRC of the self-employment by the 5th of October 2025 was due to carelessness, as Oscar did not deliberately decide not to notify HMRC. The maximum penalty is therefore 30% of the potential lost revenue of £15,000, which is the liability that should have been paid by the 31st of January 2026. However, Oscar made a prompted disclosure within 12 months of the tax becoming unpaid, so the penalty may be reduced to a minimum of 10% of the potential lost revenue. A final few points in relation to late notification penalties. They must be paid within 30 days of the date the notice assessing the penalty is issued, or interest will be charged. The decision to issue a penalty or the amount of a penalty can be appealed against. Finally, a penalty will not be charged if the taxpayer has a reasonable excuse for the failure and the failure is not deliberate. One final important thing to note here is that the notification of chargeability provisions only apply to taxpayers who have not already received a tax return from HMRC. If a person receives a tax return, it is safe to assume that HMRC already know that person exists. Therefore, any income received or gains made in the tax year can simply be disclosed on that tax return in the normal way. We've mentioned tax returns, so now let's have a look at what they are and what goes on them. Notices to file tax returns are typically issued by HMRC to taxpayers on the 6th of April immediately following the tax year. So notices to file returns for the year ended 5th of April 2025, i.e. returns for the 24-25 tax year, will usually be issued the day after the end of the tax year, i.e. on the 6th of April 2025. If an individual wishes to file a paper return rather than an online return, they will need to call HMRC to request a copy. Every tax return requires the taxpayer to provide certain details. Any taxpayer must give details of all income received from all sources in the tax year. Certain allowances to be claimed by the taxpayer also need to be claimed within the tax return. For example, a taxpayer who makes contributions to a personal pension eligible for higher rate tax relief needs to claim that relief on the return. Similarly, higher rate taxpayers should claim relief for gift aid payments made. The election for the marriage allowance is also made on the return. As well as the basic tax return, supplementary pages may also need to be completed if the taxpayer has a particular source of income. So, for example, employees need to complete employment pages to fill in. Those with rental properties need to complete the property income pages, and so on. So those taxpayers with many sources of income will complete the basic return and add on all of the supplementary pages. Any other claims for relief are made using the additional information pages of the tax return. For example, relief for any deductible payments or any tax reducers. Once the taxpayer has completed their tax return, they will sign a declaration to say that, to the best of my knowledge and belief, the tax return is correct and complete. If the tax return turns out not to be correct and complete, i.e. there are errors or omissions, then HMRC do have powers to charge penalties for incorrect returns. Whereas all income tax returns require details of a taxpayer's income and allowances, only some returns require the taxpayer to make what we call a self-assessment. There are two separate dates for filing the return, depending on whether the taxpayer is filing a paper return or an online electronic return. Where the taxpayer completes a paper return, the return should normally be filed no later than the 31st of October following the end of the tax year. Therefore, for the tax year 2024-25, the paper return must normally be filed by the 31st of October 2025. However, the paper return can be filed within 3 months of the date of issue of the return if this is later than the 31st of October. Where a taxpayer completes an online return, the return should normally be filed no later than the 31st of January following the tax year end. Therefore, for 2024-25, the online return must normally be filed by the 31st of January 2026. However, the online return can be filed within 3 months of the date of issue of the notice to file if this is later than the 31st of January. We will now consider the filing deadlines where a tax return is issued late. This might happen when a taxpayer has started in business and tells HMRC that he's chargeable to tax just before the 5th of October deadline. Here, we'll assume that a notice to file a 2024-25 tax return is issued by HMRC to a taxpayer on the 25th of November 2025. The deadline for filing the return is the later of 31st of October or 3 months from the issue of the return. So in this instance, the later of those two dates is 3 months from the issue of the return. This means that the final date for filing the return is the 25th of November 2025 plus 3 months, which takes us to the 25th of February 2026. If the return is filed by this date, HMRC cannot charge any late return penalties. There is one final deadline to be aware of in respect of tax return filing where a taxpayer has tax deducted at source via PAYE. Underpayments of tax of less than £3,000 can be collected via PAYE rather than a one-off payment. In order for this treatment to apply, if the taxpayer is filing an online return, it must be filed by the earlier deadline of the 30th of December following the end of the tax year. If a taxpayer files a return online, they do not have to worry about calculating their own tax liability. HMRC software will automatically calculate the tax liability. If the taxpayer is filing a paper return, they can self-assess their tax liability using the tax calculation summary. However, Where a return is submitted by the 31st of October, or 2 months from the issue of the notice to file if later, HMRC will calculate the tax for the taxpayer if they wish. The taxpayer will tell HMRC what their income and allowances are, and HMRC will calculate the tax on their behalf. For example, assume a notice to file a tax return for the year ended 5th of April 2025 is issued at the normal time, i.e. just after the end of the tax year, so on the 6th of April 2025. If the taxpayer wishes to file a paper return, but wants HMRC to work out their tax liability for them, i.e. they do not want to self-assess, this notice to file must be submitted no later than the 31st of October 2025, i.e. the 31st of October following the end of the tax year. Consider the position if the return was issued late. Assume HMRC send the taxpayer his 2024-25 tax return on the 3rd of September 2025. If the taxpayer does not want to self-assess, then they must submit the return by the later of the 31st of October 2025 or 2 months following the issue of the return. 2 months after the issue of the notice to file here is the 3rd of November 2025. As long as the return is with HMRC by the 3rd of November 2025, HMRC will calculate the tax liability for the taxpayer. If the taxpayer wishes to file a paper return and is happy to self-assess, the deadline is the later of the 31st of October 2025 or 3 months from the issue of the date of return, being the 3rd of December 2025. You can see that where a notice to file is issued late, the deadline for filing a paper return depends on whether the taxpayer wishes to self-assess or not. If the taxpayer misses the 3rd of December 2025 deadline in the above example, then all's not lost, because taxpayers have until the 31st of January to file their returns in order to avoid a penalty. The taxpayer would need to file an online return, in which case their tax liability will be calculated automatically. If the taxpayer misses the 31st of January 2026 deadline, HMRC will charge them penalties for the late filing of the tax return.